Hello everyone, welcome back to my channel. So apologies for my voice, I still have a bit of a sore throat, but today I want to keep the momentum going on the finance track and talk about yield curves. Yield curves are something that when I first started learning it I found very intimidating. I would even go as far as to say that I find some of the material out there is not as clear as it could be, and some of it even sometimes contradicts itself. And yield curves is one area where you find a lot of kind of overlapping terms, and I think I really wanted to kind of put something together that hopefully will kind of explain all the different types of yield curves that you might encounter and how they're constructed, what they do and what they don't do. So we're going to talk about the par yield curve, what that means, basically the plot of yield to maturity, the spot yield curve, which will introduce the concept of spot rates in general, and then bootstrapping, which is basically the concept of building up a yield curve using a series of different instruments to create a spot curve that covers the entire spectrum. If you don't know what spot curve is, don't worry, because I'm going to explain it. So without further ado, let's get started. So in its simplest form, the yield curve is a plot of the yield, right? And normally we mean the yield to maturity, but it depends on what yield curve you're talking about. But in simplest form, the yield curve, yield to maturity, plotted on the y-axis against time to maturity. Now, for what, right? Time to maturity. What are we plotting on this graph? So here we've got basically a sample yield curve with the time to maturity of various different sample instruments plotted on the x-axis with their yield to maturity based on their so we know that yield is a function of the market price or vice versa, depending on which way around you want to work it. But let's say you know the market price of these instruments, you can back out the yield to maturity, you can plot then those instruments on a graph and then draw a curve through them. Now the question is, what instruments do I show on this yield curve, right? I mean, do I just get all the instruments in the world and just plot them on here? And the answer is obviously no. The key concept in a yield curve is that all the instruments on the curve should be of approximately the same credit quality, right? And that's absolutely key, right? So the instruments should be the same quality, and the reason is that the curve is expected to show the relationship and how the yield of those instruments with the same credit quality, so the same probability of default, etc., of these underlying instruments, how that yield changes depending on how long is remaining on those instruments before they mature, right? And that's the basic framework of a yield curve. So, for example, same quality. What does that mean? So it could mean things like, so it could mean same issuer, right? So we could say, well, if a certain company like Rolls-Royce has a whole load of different corporate bonds out there in the marketplace, I could plot the yield curve for Rolls-Royce, right? Because we assume that all the Rolls-Royce instruments on that yield curve will have similar credit rating, and so with everything else being held fixed, we can actually observe the relationship between the time to maturity and the yield. And you can see, so we'll follow up on different types of shape of yield curve and how they can be read to interpret what the market's expecting about future interest rates, which is the common usage of it. We'll go into that later, but I just want to explain what they are, right? So it's basically, so in its simplest form, you just take a group of instruments, right? And then all you have to do is basically calculate the yield to maturity, right? So basically so if you know the market price, then you do a price to yield calculation, and then you know the yield, and then you get the maturity, right? So you basically note the maturity, and that's your x coordinate, and that's your y coordinate, and then you basically plot them on a graph, and that's it, right? That is your basic yield curve. Now, I don't want to sort of sometimes you hear people say, Okay, so what's a yield curve? A yield curve is a plot of the interest rates offered on a certain selection of instruments over time. I mean, it's not. So the yield curve is not. The yield to maturity, as we've seen in previous videos, is not strictly the same. Well, it's not at all the same as the coupon, the interest rate that the bond is paying out as a percentage of its face value every year or every 6 months, depending on the bond, right? The yield to maturity takes into account the market price, right? It gives you your overall rate of return, including the capital appreciation or depreciation, which you'll experience if you buy the bond at today's market price, collect the coupons, reinvest them at the yield to maturity, which is something we'll come on to, and then collect the principal or the face value of the bond back at the end, right? So, and that's what we're plotting here. So it's not true to say that it's the interest rate that's paid out if you define the interest rate as the coupon, right? Unless the price is par. So let's just talk about that for a second, okay? So if you recall from my previous videos, hopefully the price of a bond, the fair price for a bond, can be calculated using this formula, right? Where the C is your periodic coupon payment, which is basically a fixed percentage of the outstanding balance. M is that outstanding balance or the face value of the bond, right? Normally the amount of the initial bond that the issuer borrows. Y is the yield to maturity, right? And this calculation, as I've said a number of times, can go both ways. So an investor can say, well, my required yield to maturity for me to buy this bond is X, therefore what's the fair price, right? Or you can do it the other way and say, a dealer is quoting me this price, this present value for the future cash flows for this bond, therefore what value for Y, the yield to maturity, solves for that price, and then I can decide whether that is above or below my target yield to maturity, right? But anyway, I was going back to saying that the yield to maturity on a bond equals the coupon if the price equals par, right? So basically, and normally the bonds when they're first issued in the marketplace are issued at par, right? So if I have an issuer who issues a £1 million face value bond, in other words, in order to borrow £1 million or $1 million, I keep saying that, $1 million from, and he issues that bonds to investors, right? So then normally the investor will buy that bond for 1 million up front, right? So because the issuer issues the face value because that's kind of the amount of money they want to borrow. So in that case, at issuance, so when the bond's first, born, if you like, the price, which was 1 million, equals par or the face value, which is 1 million, right? But as interest rates outside in the marketplace move over time during the lifetime of that bond, right, then the price of that bond on the secondary market will shift, right? So if prevailing interest rates in the outside market go up, then this bond to a secondary market investor becomes much less attractive, right? So the price will go down. Okay, we've discussed this in previous videos, I know, but I just want to make it clear that what we're plotting on the actual the yield to maturity graph here, or the yield curve, let's say, is the yield to maturity, right? It's not the interest rate or not the coupon, unless the price is par, right? Let's say this yield curve is for Rolls-Royce, right? So Rolls-Royce, and let's say hypothetically they have all these instruments already in the marketplace, right? So Rolls-Royce have already issued these bonds, right? So this is a plot just for Rolls-Royce. And what we're saying is, so let's say this is a 5 years, 6 years, 7 years, and I'm just using simple numbers, right? These are probably not very realistic in terms of what would happen, right? But the point is, from the par yield curve, right? Let's say that they've got these bonds. Then the par yield curve that they've already got available to them will tell them, if we want to issue a bond today that's going to mature in 7.5 years' time. Again, these numbers are very unrealistic. I'm just illustrating the concept, right? They want to borrow some money for 7.5 years, and they want to sell it at par today. They would basically be able to read off from this curve and estimate what the coupon would be that they'll have to offer on that bond for it to sell in the market at par today, right? So that's basically the concept of par yield curve. So it's basically, as ever, it's a plot of yield to maturity against, or let's say time to maturity against yield to maturity, but it's used to basically, it's used to read off from the x-axis and say, for a bond of equivalent credit quality as the bonds that have been used to make up this curve, what coupon would I have to issue that bond at today for it to sell at par, right? So that's basically the par yield curve. So if we go back to the formula for yield to maturity, we're going to start talking about spot rates, right? So and also some of the limitations of the I'm just going to try and keep it a bit colourful. So spot rates. So I'm going to draw out this the longhand formula for the bond price again, right? So the price of the bond was, if you remember, it's the present value of the cash flows, and I'm going to write out the longhand way. It's basically the first coupon divided by 1 plus the yield, right, plus the second coupon divided by 1 plus the yield squared. This is assuming, obviously, that this is the price at a coupon date, so we're not talking about any complications that we've talked about in previous videos about being between coupon payments. So that all applies, but this we're just breaking it down and using a simple scenario. So etc. etc. Let's do one more. So the third coupon divided by 1 plus the annual yield to the power. We're assuming, let's say, annual coupons. Right. Plus all the way up to however many periods there are n periods, so the last coupon plus the principal divided by 1 plus the yield to the power n, right? So if this is not familiar, please go back and see the videos on the bond pricing and how and discounting and stuff. But we're effectively saying we're discounting each coupon payment by the same yield to maturity, the same rate, including the final one, and that gives us the present value or the price of the bond, right? So the thing about yield to maturity is, if you think about what this bond is in terms of the cash flows, right? The bond, from an investor's perspective, is basically a series of bullet payments that arrive at various points in the future, right? So let's just draw the timeline here, right? I'm getting better at drawing straight lines, I'm happy to say. So we've got these, so t equals 1 year, 2 years, 3 years, 4 years, 5 years, etc., 6 years, all the way up to n years, right? And then the final cash flow is a bit more, C plus M, right? So, and this is the amount of money that we get at that time. So each of these cash flows, you can treat it like a separate payment, right? It's like a after 1 year I'm getting the coupon, right, which is, let's say, $100,000. The point is, what we're doing is we're asking that the price we're calculating as the sum of the present value of all those cash flows, but we're using, when we discount by the yield to maturity, we're effectively applying exactly the same discount rate to each point in time in the future, right? Which effectively is saying let's take the third coupon payment here, which arrives at this time here, right? We're asking, how much is that coupon payment worth? Well, as in, how much would we have to invest today for 3 years so that the amount that we receive after 3 years is C? But realistically, okay, and this is really important, realistically, to achieve a final value of C, right, a final payment of C, if we were to invest, excuse me, my throat is playing up a bit. If we were to invest an initial amount of money to end up at a value of C after 3 years, what would that amount have to be if the interest rate that we're using to achieve that is our yield to maturity? So something's a bit wrong here, as in, intuitively you should be saying, well, okay, the alternative interest rate that's available to me to achieve a final value of C if I tie up my money for 1 year is actually not the same as the interest rate that is available to me to tie up a certain amount of money to get the value C after 2 years. And that's not the same rate as would be available to me if somebody said, invest, your target is to achieve a final value of C in 3 years, right? Because generally speaking, if you go to the bank, right, and you say, oh, hey, savings guy, I want to invest some money, and I want to, my target is that by 4 years' time, my savings rate is this, right? And what interest rate is available to me, right? Then he say, well, are you prepared to lock up your money? And you say, yes, yeah. I mean, my only target is to reach this amount of money after 4 years. I'm not going to touch the money. I'm just waiting for that final payment in 4 years. He'd be like, okay, well, 4 years is a good amount of time. We'll give you a good interest rate for that, right? So the interest rate that you that he'll offer you for 4 years would be higher than the one that if you went into the bank and said, right, I want to, my goal is to save such and such an amount in 1 year. Can you help me? What interest rate can you give me for 1 year? I'm only locking my money up for 1 year. The bank man, the bank guy would say, well, sorry, it's going to be a much lower interest rate than if you lock up your money for 4 years, right? So the yield to maturity is kind of, it's using the same discount rate for each cash flow, which and that what that really assumes effectively is that the yield to maturity is the return that you will make, okay, equivalently by investing the price, right? So you invest the price at the yield to maturity, right? Assuming it's a flat rate over n years, right? That amount of money is equivalent to the same as collecting all the cash flows and reinvesting them at the yield to maturity from the point that you receive them until the maturity, right? So don't worry too much if that's confusing, but basically it's saying that your return will be, let's say your yield to maturity is 3%. What it means is that as long as you take each of these coupon payments as they arrive, and as long as you reinvest them elsewhere outside the bond, because remember, you can't put them back inside the bond. The bond just spits money at you. You can't reinvest back inside it. So as long as you can find somewhere else to reinvest that money at 3%, then your overall return over n years will be 3%. And if you think about it, that's exactly the same as what we were just talking about in the bank there, when you say to a savings manager in a bank, I want to achieve £10,000 savings in 4 years. How much money do I have to invest in that account, right, today, so that in 4 years' time it'll be worth $10,000? And they'll say, well, the interest rate for 4 years compounding, right, is let's say 2.5%, right? And that's basically assuming that you don't take any money out. The 2.5% will be paid annually, and it will compound annually, right? Which is where you get this exponent from, and you will basically you will end up with £10,000 balance at the end of the month, at the end of the 4 years, my apologies, as long as you invest the present value of that cash flow today, right? So spot rates, the spot rate, the concept of a spot rate is to say, right, I need to price this bond, I need to find a fair value for this bond, right, in the marketplace, and the bond, all I know about the bond is that it's going to pay these cash flows, right, coupon, at these times, right, and the maturity at the end at t equals n. And I need to find out what's the fair price for that bond, right? So again, it goes back to, well, what's our alternative rate outside the market, right? That's our discount rate that we use to discount. And if we use the yield to maturity, if we use a constant rate, right? If we use a constant rate to discount all the cash flows, we're kind of assuming that the discount rate for each of these time periods is the same, which is not the case, because we've just discussed that. You know, if the rates available to me to tie up my money for 4 years are different than the rates available to me to tie up my money for 2 years. So the spot rate is basically a way to find a fair discount rate that's applicable to the actual point in time at which the cash flows occur, right? That's really, really important. Okay. Now, that doesn't mean the yield to maturity goes out the window. The point is that the workflow, the way you would do it is you say, you start with your bond, right, which is basically your coupons and principal payment, right, and your time schedule, right. You start with that. Then you say, discount the cash flows, each cash flow, at the corresponding spot rate of time t, right? Sum those together, and that gives you the price. And then calculate your yield to maturity as a function of the price. Does that make sense? So basically, you start with a bond, it pays a well-known stream of cash flows. You look at the time period at which each of those cash flows arrives, and then you use the yield curve, right, that's applicable for that credit quality, for that bond, and says, what's the appropriate spot rate, what's the appropriate discount factor, let's say for 1 year, for 2 years, for 3 years, and you use those respective discount factors to discount each cash flow at the spot rate that's a function of the time at which the cash flow occurs. You sum those together, that gives you the fair price of the bond, right? It's a more accurate way of doing it than just taking one fixed, constant interest rate, right, and discounting all the cash flows at the same rate. So that gives you the price, and then if you want to calculate the yield to maturity after that, then you go the other way, right? Then you say, okay, well, now the yield to maturity is a function of the price. So the price I've calculated as, okay, let's say PV, the price, equals C over 1 plus, let's say S1, spot rate 1, plus C over 1 plus spot rate period 2 squared, plus C over 1 plus S3 cubed, plus, all the way up to C plus M over 1 plus the spot rate for time equals N to the power N, right? That's how we calculated our price, right? And these S1, S2, S3 and Sn, they are read from a spot rate curve, which we're going to talk about in a second, right? How we create that spot curve, because that's the next step. It's really important. So we read those values off there. So we say, okay, t equals 1, 2, 3. We read off the values from the spot curve, and then we use those values, right? S1, S2. We use those values to discount the cash flows, right? Then that gives us the price, right? But then we go the other way and we say this whole thing also equals C over 1 plus yield to maturity plus C over 1 plus yield to maturity squared plus C over 1 plus yield to maturity cubed, all the way up to C plus M over 1 plus the yield to maturity to the power n, right? So basically what we're saying is these two streams are equal, and they're equal by setting them equal to each other. What we're saying is the yield to maturity, as always, is the constant discount rate that applies, that basically equates the present value of the cash flows to the price of the bond. But the price of the bond we've derived from the actual spot rates that apply to the time at which each cash flow appears. So looking closer at this, you can basically see this is not a simple equation to solve, but you can see in the blue here, right? I'm just going to brighten it up a bit. In blue here, on the bottom, you've got yield to maturity squared cubed to the n, and on top here you've got S1, S2, S3, and S to the n. So in some way, what you can see is that the yield to maturity is in actual fact some kind of geometric mean of the spot rates of all the cash flows that actually occur, the spot rates for the time to which the cash flows occur. My apologies. Right. So the yield to maturity is kind of like a geometric mean of all the different spot rates. So let's focus on this. So where do we get this fantastic spot curve from that enables us to get a more accurate discount rate for each of the cash flows to get a better price, right? A more accurate and fairer representation of the true value of the bond, right? The answer is a concept called bootstrapping. Bootstrapping is a very cool thing, and I'm hopefully going to make it abundantly clear exactly what it means, right? So bootstrapping is a process of going from the yield to maturity yield curve to a spot curve, right? And how on earth do we do that? Well, it's quite simple, right? And I'll hopefully illustrate why that is. So first of all, if you can find, let's say we're trying to find the Rolls-Royce, so let's say we have the Rolls-Royce yield to maturity yield curve, right? So basically from time is 1, 2, 3, we have 10 years, and it goes all the way up to 30 million years, or okay, I'm being stupid, but the yield to maturity, right? And so this is the existing Rolls-Royce yield curve, right? Now, how do we get the spot curve for Rolls-Royce, right? So that when we want to value another bond, right, that Rolls-Royce are issuing in future, how can we get the spot rate to value those cash flows? So the key thing is, right, so if we can find a bond for Rolls-Royce that has basically only one cash flow remaining, right? So no coupon, no intermediate coupons, only the last cash flow, which is basically this one here, right? That's the only one remaining. Then the price of that bond is basically C plus M, coupon plus the principal, divided by 1 plus the spot rate, right? For T equals 1, so 1 period, because this has 1 year remaining, right? And that equals the price. So if we know the price, right, then we can actually calculate what the spot rate for 1 year is, right? So let's actually start plotting. I'm not going to do any calculations here, but I'm just going to illustrate. So this is the first one here, right? This is the yield curve, right? Yield to maturity curve, and this one is the spot curve, right? So again, this is T. Same concept there, but this is the spot rate, right? So what we're saying is, if we know the price of any instrument that only has one cash flow remaining, right, and that's the final cash flow, then because this is the last cash flow, we know that the yield to maturity and the spot rate are the same, right? Because if you look at this equation, right, if all of these cash flows don't apply anymore because they've already been paid out, then this must equal this, which means that the spot rate equals the yield to maturity, right? So actually, solving for this is trivial. It's just the same. The yield to maturity equals the spot rate. So basically, we can plot S1 directly on that point, right? And that's equals the yield to maturity of bond 1, right? So we have our first spot rate. That's fantastic. So what can we do now, right? So now what we have to do is we have to find the price, or we have to look at the yield for the bond for a Rolls-Royce bond that matures after 2 years, right? And then we can solve, and I'll show you, and it works. It's very simple, right? So if we go back to our formula, it all comes down to this formula here, right? So I'm just going to write it out again. So for a bond that matures in 2 years from now, we can say that the C over 1 plus S1 plus C over 1 plus S2, right, plus M squared, because we only have two remaining, equals C plus, so C over 1 plus yield to maturity plus C plus M over 1 plus yield to maturity squared, right? Look at this, right? So now we know S1, right? We've already calculated it from the 1 year point, right? And so we know this one. We know this one, right? Because we read it from here, right? And we obviously that's the same number. We know C, we know M. So we can basically, the only unknown in this equation is S2. Fantastic. So we now know we can solve this, rearrange this and solve it iteratively to find out S2. So that enables us to plot S2. By the way, this curve doesn't exist in advance, right? I'm just kind of backwards writing it. So that would be S2, right? Similarly, if you read point 3, like time maturity, what's the yield to maturity of a Rolls-Royce bond maturing in 3 years, right? And you read that off there, right? Y to N 3, right? And then again, we can write the same equation down here. It would be C over 1 plus S1 plus C over 1 plus S2 plus C plus M divided by 1 plus S3 to the power 3 equals C over 1 plus YTM, let's put YTM3, so yield to maturity of the 3 year bond, right, YTM3, plus C over 1 plus YTM3 squared plus C plus M divided by 1 plus YTM3 to the power 3. And once again, I'm going in reverse with my colours this time. So once again, we know S1, right? It's this one. We know S2, right? It's this one. We're trying to solve for S3, right? We know YTM3, it's this value here, and that's the same there and the same there. So rearranging and solving for S3, we can now plot our S3 point on there. We plot that. So this, again, this curve here is basically in reverse, would be a line of best fit through the points that we're currently building, right? So probably I shouldn't have drawn it in the first place, but hopefully you can see now that that's how you can build a spot curve, right? That's how you can build a spot curve from the yield curve. right? So you take the yield curve of coupon paying bonds, right? So this is the yield to maturity. Just take all the Rolls-Royce bonds you can find, plot the yield to maturity, right, which is the discount rate the single discount rate that discounts all the cash flows back to the price. Plot that on a graph, and then you can use this bootstrapping technique, right, to infer the spot rate curve, right? So now once we have our spot curve, so basically this, and I'll just draw it slightly neater down below, right? So once we have our spot curve, so my apologies, so T and then spot rate T. So we're basically just copying this at the same points down here. So we gather as many of these data points as we want from the yield curve. We bootstrap the spot curve for each period, right? So we have a spot rate. We draw a line through them that kind of fits all the points the best, right? And then that line is I'm just redrawing it here. So it's some kind of spot curve like this. Time equals 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, etc., etc. And this now forms the basis, right? This is your spot curve for Rolls-Royce. This now forms the basis for actually pricing and discounting cash flows from any point in time. So if I have a random Rolls-Royce bond in the secondary market that I'm thinking about buying, I can look at the cash flows, right? Each one of them, and then read off the time, right? So for each cash flow, read off the spot rate from there, and then discount the cash flow, right, at spot rate T, and that gives me my price, right? So that's why the spot curve is so useful, because it allows you to basically to have a simple and realistic discount rate for every point in time out in the future. But because you see the key thing was we had to start bootstrapping our spot curve with one instrument that had no reinvestment coupons remaining. It only had its final principal, and then we built up from there using coupon paying instruments, using this bootstrapping technique and solving for the highest spot rate for the last period. So by doing that, we've actually managed to convert yield to maturity for coupon paying instruments long into the future into spot rates, which are the fair discount rates for that particular risk profile, for a zero coupon payment, right? A zero coupon bullet payment in the future with no intermediate coupons, right? And that's a very powerful thing in the marketplace. And we'll see in the next video basically how the spot curve, right? And this is really cool as well. How the spot curve can drive and enable you to calculate implied forward rates, right? Forward rates, and by forward rates I mean what's the implied prediction of what the interest rates are going to be in the future. So and basically it's really it's really important to kind of visualize what drives what here. So basically the yield to maturity curve can be bootstrapped to create a spot curve, and then the spot curve from then gives you a platform to discount any cash flows arriving at any point in time, and also to calculate implied forward rates. In the next video, we're going to talk a little bit about treasuries, because when we talk about the spot curve, and it's a bit too much to fit in one video, but the spot curve,
one of the most common spot curves that gets talked about is the US Treasury curve, right? And so showing how we can actually build a US Treasury spot curve is going to be very important, because the US Treasury curve is extremely significant, and I'm going to go into that in more detail next time. So that's the basic introduction to yield curves. So when somebody says a yield curve, just be clear: is it a spot curve? Is it a yield to maturity curve? Par yield curves we looked at was basically the plot of what the coupon would be on a particular bond of a particular time to maturity if we issued it today and we wanted to sell it at par, right? So lots of content there, but it's really not a topic that should be too scary, but it is worthwhile sort of spending some time to digest it. So any feedback or comments, please leave them down below. Thanks for watching, and I will see you in the next video.